So welcome to this edition of Apartment Wealth Nuggets, what I call the quick shortcut to small apartment investing. And this is going to be a quick presentation. I'm going to be respectful of everyone's time, and we're going to use this to give topics, I call them nuggets, relevant to small apartment investing. And so this segment is one that's of interest to anybody, whether you are already very active in owning real estate, or you're contemplating getting involved in owning real estate, or maybe you're started but don't yet own anything. These are real estate tax secrets which your CPA may not tell you. And frankly, sometimes you're not even aware of some of these. I have learned these over the years. We're going to be covering about a dozen to 15 different ways to handle tax secrets at each of the different stages of a transaction, or each of the different stages of your journey into real estate. And so to welcome everyone, if you're not familiar with me, my name is Lance Edwards. So this is going to be a short presentation, about 15 minutes, and then I'm going to take some questions. So I'm going to go through this. I'll give you the highlights. So if there's anything you'd like me to elaborate on, then I'll do that during the Q&A period. First thing, let me say this, warning, I am not a trained tax professional. I'm not a CPA. What I'm going to be sharing with you, I'm not giving tax advice, so you need to see your own tax preparer with regards to your own situation. What I'm sharing with you is what I do in my business, what I've done over 20 years of real estate, of how I've learned it, how I've applied these tremendous tax benefits that have been afforded to us as real estate owners, and as well as small business owners. Because really, you look at the tax code, the greatest benefits come or awarded to people who own real estate and people who own small businesses. Well, really, we're both of those. So we get the benefit of applying both of those. So let me jump through these with you. So first of all, before you even own any real estate, there are tax deductions afforded to you. Now, this comes in the category of small business tax deductions that you are able to take right now. You do not have to have yet even made a profit yet in order to claim these deductions. You just have to show that you were intended to make a profit. Well, I don't think anybody goes in business with the intent not to make a profit. You just can't. This won't apply to your hobbies. And if you're, for some reason, running a nonprofit, this, of course, that's a whole other category by itself. So what are some of the things you can deduct before you buy your first piece of real estate? Even when you own real estate, you can be deducting these things. Well, first of all, home office. If you have a legitimate home office that you use it for home office purposes. Now, it can't be, your basement that your kids have the ping pong table in, and you bring the guys over for beer on football Saturday. Not that. It's got to be a space that's legitimately carved out 100% purpose of your home office. You deduct that space of your living space, and whatever you're paying towards rent or your mortgage or the other expenses associated with obtaining that, you can deduct that percentage of your square footage as a business deduction. I did that when I was getting started years ago. And like I say, of course, you don't need to be making a profit to get the deduction. You just have to show that you had the intent to make a profit. Also, your business education. So when I was getting started, I was going to a lot of seminars. I was learning how to start a business. And then I was getting coached along the way before I'd actually done a deal. I was paying for all these. Those are business expenses. So you want to make sure you're deducting those. Those of you that are clients of mine, you should be deducting that. All of your business education, all your coaching, you should be deducting that as well. And so whatever that cost is, take your tax bracket. Let's say it's 30%, multiply it times 30%. That's how much you're going to reduce your tax bill, which means you just boosted your cash flow by that much. Travel, business-related travel can be deducted. Of course, your office supplies, your computer, your printer, your paper, anything you need to run your business, any type of supplies, your phone, all right, your internet service, all these things are business deductions that you can apply today. And then your auto mileage. If you're driving to Staples to buy a printer, you get to deduct the printer, plus you get to deduct the mileage to and from Staples. Now, the best way to do this is, in the old days, I used to save up all my miles, and then I would submit it to my CPA, and he'd enter it. Kind of a pain. Here's what he taught me. A simpler way to do it is, every week or two, make an expense report where you're writing an expense report from you personally to your company. So in my case, it's from Lance Edwards' expense report to my company. And if I use my car to drive to the airport to go visit a property, then I would put, on these dates, round trip to Houston Hobby Airport, 106 miles, times the mileage rate, which whatever that is these days, I don't even know, 60 cents a mile. That's a $60 check. The company's going to write me a check. Now, that works great if you already got cash flow going in, and it's easier that way once you're up and going. The alternative is to do what I used to do when I didn't have any money coming in yet. I would just simply you have to keep a mileage log, and then give that information to your CPA at each tax season, and they will deduct it on your tax return, so you reduce your tax bill that way. All right, so now I got you in the mindset, and these things, even when you own apartments, you should be doing these things continuously. So no matter where you are, if you have the intent to make a profit, you should be doing these things. The next part of your real estate journey is when you own a small apartment building. So you get everything we talked about before on the prior slide. Before you buy, you still get all those things. Plus, we're going to add the income that you make off of your rental properties is taxed as passive income. Now, that's the lowest tax rate there is. That's the lowest tax. So passive income is taxed at the lowest tax rates. That's a break for us. Far less than the tax rates you're paying if you have a JOB, for example. Far less than the tax rates you're paying if you're wholesaling properties. Wholesaling properties is the highest tax rate you're going to pay. Passive income is the lowest tax rate you're going to pay. But there's ways to not pay any tax on passive income, and that's through depreciation. Now, gosh, we could do a whole session on depreciation, but I'm gonna just make you aware of some things. I want you to be asking your questions to your CPA about this. So, the two types of depreciation. There's straight depreciation. Straight depreciation is, as it sounds, the IRS allows us to assume that the value of our real estate is going down in a linear. Let me see if I can draw a chart. This will be faster. I can make this technology work. Let's see. All right, let me share the screen. And we're getting sophisticated now. We're going to do a sketch here. All right, so all right, let's take a chart. Here's time. And this is our apartment building. Improved value. Now, the key word is improved. What I mean by that, we cannot depreciate land. So if you have $1 million building, $1 million apartment complex, let's assume 20% of that is the land value. So only 80% can you depreciate. So 80% of $1 million is $800,000. So let's say, whoops. When I start, the day I take title, the building value, quote, the improved value, not counting the land, $800,000. Straight line appreciation is over a period of 27 and a half years. I don't know why it's 27 and a half. The IRS assumes that in a straight line, the value of that building is going down in a straight line just like that. Actually, it would be zero, right? You can go. Anyway, you know it. So how much is it going down each year? Well, if you take 800,000 and divide that by 27.5 years, I'll just do it right here on my calculator, my handy dandy phone. 800,000 divided by 27.5 is a $29,090 per year deduction. That's guaranteed automatic. You get that as straight line depreciation. So if you made $28,000 in passive income, this deduction wipes out any tax you'll pay on the $28,000. Now let's say it was $28,000 passive income, and so you have what's that, $1,900 left over. If you don't use all the deduction, it carries over into next year. It carries forward. Now that's straight line depreciation, but it assumes the value is the building's value is depreciating over 27.5 years. Now in actuality, what's happening in actuality, the building's value is not going down. It's going up through forced depreciation. But for tax purposes, it's going down. So you make sure you're getting that. Now, there is a aspect of this that your CPA may not ask you about, and it's an important part of this, is that whether or not you are a real estate professional. Because after, let's say in the example I just had, I had $28,000 of passive income, I had $29,000 of depreciation. You can deduct all of your depreciation against your passive income. But what about your active income? What about the income you make from your JOB? What about the income you make from wholesaling property? That's active income. Well, normally you're limited about how much of that depreciation you can deduct against active income. It's a small number. It's a small number, unless you are declared a real estate professional. If you're a real estate professional, 100% of depreciation can be taken in any year. And in a moment, when I show you bonus depreciation, I'm going to show you why this is even more significant to you. So what does it mean to be a real estate professional? It has nothing to do with having a license. It has to do with how many hours you spend in business, and what portion of your activity is devoted to real estate. So depending upon where you are in your journey, you can be a real estate professional. I'm a real estate professional. I don't have a license, but I spend sufficient number of hours on my real estate business, and have my activities are meeting the criteria. So in order to be qualified as a real estate professional, you have to ask your CPA. Now, if you don't bring this up to them, they will not ask you necessarily. All they do is they check a box on your tax return whether you're a real estate professional. And you want to ask your CPA, do I qualify as a real estate professional? And every time you submit your taxes every year, you want to put a reminder, am I a real estate professional? Am I a real estate professional? Because this is a huge benefit to you. Let me show you why. Let's go back to the slides. And it becomes even more significant when we talk about bonus depreciation. Straight depreciation is over 27.5 years. Bonus depreciation allows me to accelerate that depreciation up into the first year, year number 1. So let me give you an example. I own a property that's 56 units. I paid $3.15 million for it. And let's say the building value is 80%, times 0.8, $2.5 million. So I can depreciate $2.5 million. Well, with straight depreciation, divide that by 27.5 years, that's $91,000 deduction. I get that's nice. That's good. That's nice. $91,000 deduction every year. With bonus depreciation, what I was able to do is my first year deduction was not $91,000, it was $530,000 deduction. And if you're at a tax rate of 30%, that's $159,000 tax bill reduction for you. That could knock out your tax rate for a couple of years. So now this is where that real estate professional is really important, because if you're not a real estate professional, you're going to be limited to the bonus depreciation to how much your passive income is, plus the caps that the IRS puts on it. So that's why this real estate professional is really, really important for you. All right, the next thing, when you own a property, you also get to deduct the interest on your mortgage loans. Same as on your home. If you own a home, you get to deduct that interest. On the properties you're buying, you get to deduct that interest, of which your renters are paying for you, right? And then the other way that you can utilize the tax law is if you've built up a bunch of equity in a piece of real estate and you have a lot of equity and you want to, quote, harvest that equity into cash, well, you could sell the property. But if you sell the property, you're going to pay long-term capital gains. If you'd like to harvest that equity and pay no tax, then what you do is you refinance the property, put a new loan in place, pay off the old loan, put a new loan in place, and you pull out that cash, and that cash is tax-free, because a loan is not a taxable event. So you could refi that property, pull the cash out, take the cash, use it as down payment on another one, and do it all over again. That's the strategy I teach called leverage and velocity. So when you own, I want you to be cognizant of all these things, because frankly, the biggest leverage in your small apartment business is the equity you create, not the cash flow. It's the equity. The ratio of equity gains to cash flow gains is 13 to 1. It's at least more than 10x. So every time you raise the rent, you're creating that equity. Every time you potentialize the property, you're boosting that equity. You want to be able to harvest that equity and use it to go buy another apartment building and do it over and over. That is the leverage and velocity example. That's how you create rapid wealth creation. Tax-free. Tax-free. All right, let's look at another segment. You're going to get to the point where you want to sell. So when you sell the property, if you sell it outright, like I just mentioned, you're going to pay long-term capital gains, which are still tax advantage relative to your active income. But nevertheless, you got to pay it. If you don't want to pay the capital gains, then you're going to do what's called a 1031 exchange. Now, a 1031 exchange is somewhat involved, but what the IRS code says, and this comes from section 1031 of the IRS code, that's where the 1031 exchange name comes from. You sell a piece of real estate. All right, you have 45 days to specify which properties you're going to buy next, and then you got 6 months from when you sold to buy that new property. Now, when you sell the old property, the money doesn't go into our hands, it goes into an intermediary hand, a 1031 intermediary. They hold the money. You're going to specify to them within 45 days what properties you're going to buy next, and you can have a list of properties. And then within 6 months, you have to close on that new property, and the intermediary will release your funds. If you do that, you will not be taxed. And you can do that over and over and over for your entire life. And when you die, as an estate planning standpoint, and you pass those properties on to your heirs, the basis resets. They never pay a tax on it either. So you can really stick it Uncle Sam by dying and hand it over to your kids. That's kind of a tough way to stick it to Uncle Sam. But 1031 exchange, you got to be aware of the time limits. That's where people get caught. And you get this sequence, you got to be able to find a property in time, etc. So, but 1031 exchange is out there. Another way to avoid paying your capital gains tax when you sell a property is through seller financing. I am buying a property right now on seller financing. The seller is selling me on seller financing because if he gets all cash, he takes a huge capital gains tax hit because he bought his property on a 1031 exchange, and he bought the property before that on a 1031 exchange. So if he has two 1031 exchanges where the tax burden, the tax bill has been passed down and passed down. If he sells and takes cash, the Grim Reaper taxman is going to be standing there I can guarantee you at the closing door. So he's selling me on seller financing because He only pays, and to define seller financing, he's selling it to me, and I'm going to give him some cash up front, but the bulk of his payment is going to be in monthly installment payments over time. And the IRS calls them installment payments. He only pays tax on the cash that he receives at any time. So in the first year, he'll receive tax. He'll be taxed on the down payment I give him plus 12 months of payments. And the second year, he'll get taxed on the second year of payments, the third year, etc. And so that is one of the main tax advantages of somebody who's held a property for a long time. They've built up a lot of depreciation recapture, because that depreciation will be recaptured when you sell, unless you use some of the techniques I'm telling you here. So seller financing. So that's another way you can do it. I've sold properties on seller. I love seller financing. I love getting the monthly checks, and I make a lot more money with seller financing. All right, another way, a fourth way that you can sell a property and pay no tax is you can, quote, sell on a master lease option. I own a property. I operate a property now that I acquired on a master lease option. The family who owned it, it's a 44-unit property, they, quote, sold it to me on a master lease option. When I say sold, I have a 5-year option to buy it, and I have a 5-year master lease agreement. Master lease means I'm the master tenant. I get to operate that property as if it's my own. I pay all the bills. I get to collect all the revenue. I get to make all the improvements. I run it as if it's my own, but the title is still in their name, the original owner's name. Now, because title has not transferred from them, they did not have a tax bill. They don't have capital gains tax obligation to the IRS because they have not transferred title to me. After 5 years, when that option gets exercised by me, then they will have to exercise their capital gain. So it's a way of kicking the can down the road. Is another way of doing this. All right, so that's when you're selling. All these advantages are here for you from the tax. And you know, this is all IRS. This is all IRS. This is why, you know, this is legally taking advantage of all the tax laws that have been put in place and fought for by our representatives in Washington, D.C. As real estate entrepreneurs, real estate owners. Now, this last category, if you want to get out of your asset, get out of your apartment, but you don't want to pay the capital gains tax, and you want to be able to make sure that when you die, the property still keeps paying your heirs, then you want to pay attention to this. Now, this is a little bit more sophisticated, not a lot, but a little more sophisticated, and few people know about this. So let's say you have a 50-unit building, and you've had it for years. You're looking to, you know, get out of involvement with all of your real estate. You have a couple of adult sons. You want to make sure that the passive income and all the wealth you've created in this asset is going to pass to your adult sons, and you don't want to pay a tax bill. The way you do that is you would sell it to someone like me, an asset manager like me. You're going to partner with me. And I'm going to take over the asset management. I'm going to be responsible for everything. Improvements, collecting the revenue, making repairs. I handle everything. And what we're going to do is it's a done-for-you service. We're going to be in business together. We're going to be partnered. Now, because we've done it as a partnership, well, let me jump down to item number F. Let me kind of explain how this works. We're going to partner on this property. I'm going to run it. And we're going to split everything 60-40. And you get the 60. And you get paid first. I'll even provide guarantees on it. Now, why would you do that? Because why you're going to do that is multiple reasons. Item C, that is a taxless transfer. You will pay no tax on that transfer. You're simply putting it into a partnership. You will get equity share on the profits. And you'll get equity share on the depreciation. So you can continue getting the depreciation benefit. You can continue getting a percentage of the profit, 60% of the profits. And you continue to get 60% of the equity gain on that asset. So why would you do that? Because when you pass, those payments would transfer from you to your heirs if you like. Everything transfers to your heirs, and you're not taking the big tax hit up front. And I will show you, if you have a situation like this, I would love to talk to you. If you got 50 doors or more, and this is your situation, I would love to talk to you because I will show you how under my asset management, 60% of what I make will be worth more to you than 100% of what you're doing right now. Because I'm going to potentialize it. This is all my company does. So this is a way to get more value out of the property. It's effectively wealth without landlording. You continue getting the benefits of that asset, but you have zero responsibility. And when it comes to any improvements, I'll make the improvements on the property using my money. And we'll pay off your mortgage. So get you just completely off the property. That's called a partnership, equity partnership. And that's a way that you can, again, avoid the tax man, plus get all the other benefits that we're talking about right here.